Good afternoon. This is such a happy and wonderful occasion. I'm Martha Minow. I'm the Dean of Harvard Law School, and it is with enormous pleasure that I welcome you all here as we gather to honor Tom Brennan on his appointment as the Stanley S. Surrey Professor of Law. And you can join me. But settle back for a minute because I have some things to say. And I'm sorry this embarrasses you, Tom. I am particularly pleased to welcome some special guests here tonight. Some of Tom's family are here. His wife, Catherine, his father, Tom, his aunt, Sister Mary Jo Gallagher, and his brother, Joe Brennan. I also extend welcome to Mike Schlur, who was a partner at Cravath, Swaine & Moore, with whom Tom worked when he practiced there, and his dear friends, Tom's dear friends, Bill Gentry and Henry and Rachel Cohen. We also welcome MIT mathematics professor David Jerrison, who advised Tom on his PhD thesis. I'm not sure if he's here. Not yet? Well, when he is, we will actually quiz him about your thesis. To give the distinguished Stanley S. Surrey Professorship is really a tremendous honor. When I studied public finance, Stan Surrey figured so prominently, and I want to tell you a little bit behind this professorship and why it is such a fitting chair for Tom. Stan Surrey was the dominant figure in the world of tax and tax policy in the mid-20th century. He worked for the National Recovery Administration, the National Labor Relations Board. He worked as tax counsel for the United States Treasury. He first taught at Berkeley and then joined Harvard Law School as a professor and director of the International Program in Taxation. And to this day, as dean, I travel the world and hear from people about the impact of that program. In 1969, he became the Jeremiah Smith Professor of Law and became emeritus in 1981. He made extraordinary contributions to the improvement and modernization of tax systems, not only in the United States, but also in Latin America, in the Middle East, in Asia. He was a member of the American Tax Mission to Japan and helped to develop a tax system for that country after World War II. In his involvement in American tax reform, starting in 1948, he was the chief reporter of the American Law Institute's Federal Income Tax Project, and he guided its many reforms, including a reform of the IRS code in 1954. And he supervised that project between 1975 and 1984. He directed the publication of the World Tax Series and trained more than 700 tax officials and teachers from around the globe. A master in coordinating interdisciplinary approaches to tax policy, he encouraged lawyers and economists and business people and social scientists to work together. I hope you're seeing some themes that you'll hear echoed in Tom Brennan's career and aspirations. And just a word or two more about Stan Surrey. He served in the Kennedy and Johnson administrations, and he helped lay the groundwork for the last big tax reform act. Tom, it's your turn. So that's a bit about him. Now, Tom Brennan. Tom Brennan received his undergraduate degree summa cum laude in mathematics from Princeton, his PhD in mathematics from Harvard. It's worth noting the title of his thesis. Are you ready? Variation of capacity for convex domains in Euclidean space. Okay. He received his law degree here, and he said that he developed his love of tax under the guidance of Bill Andrews and Al Warren. And he worked as a strategist then in the capital market strategy group of Goldman Sachs. He also worked as an associate in the tax department of Cravath, Swaine & Moore. He's a trifecta: theory, practice, practice on the law side, practice on the finance side. His role as an academic included serving as an assistant professor of law at Drexel University, being a visiting scholar with the Laboratory for Financial Engineering at the MIT Sloan School of Management, lecturing in finance and economics at Boston University School of Management. And we then watched him move to the Midwest. And I like the Midwest. I'm glad that you spent time at Northwestern, and that was not only at the law school, but also in the Kellogg School of Management. But I'm even gladder that you returned to Harvard Law School to teach in 2015, when Tom said he was, and I quote, incredibly excited to have the opportunity to share his passion for the subject with a new generation of students. His research focuses on applying finance and economics to analyze and inform tax policy, and using empirical methods to investigate the effects of tax laws and the strategic behavior of tax players. His subjects cover an incredible range, from tax law, judicial decisions, and show important analyses of policy effectiveness with lessons for practitioners, policymakers, and scholars. He co-authored, for example, important work on portfolio theory. He has written increasingly his work on the delta-based test to test the evaluation of dividend equivalence. And he found that superficial labeling of instruments rather than the underlying economics has an effect. And this, I think, is the kind of work that he does so effectively. It exposes the way that people game the system and the way that policies do not achieve what they were supposed to achieve. And that's exemplified by his work on the effectiveness of the tax holiday granted to corporations under the Americans Jobs Creation Act of 2004. The program was credited with creating $300 billion in dividends, but Tom showed that these short-term earnings were largely offset by increased new investment in foreign earnings overseas, a phenomenon that we are still dealing with today. One of his current papers asks, what is the price of tax? An essential question to guiding tax policy reform issues today. His work on smooth retirement accounts affects, I think, some of us who are thinking about retirement. So thank you, Tom. Today, he's going to give us a glimpse of his latest thinking about taxation and a look at how he, like Stanley Surrey, combines theory and practicality to ask the most difficult questions about tax law and policy. And I will turn to Tom in a moment, but not before sharing a few comments from his colleagues. Louis Kaplow, who's here today, says, "What's Tom's idea of fun?" And Louis answers, while driving home from a tax conference, toddlers in tow, he thought about the most challenging paper and commentary, derived an original, different, and correct solution, and emailed the write-up to all concerned from his hotel room midway home. All of this in a day's drive. Louis also says that Tom's biggest problem is his indecision. He can't decide whether he likes tax or mathematics more. But then who can blame him? Al Warren says, although as a mathematician Tom has excelled at ethereal levels of abstraction, his personal tastes have always been very down to earth. For example, when he left Cravath, where he was a young tax associate, to go to Goldman Sachs to work on capital market strategies, Tom opted out of the usual fancy Manhattan send-off and chose instead a simple meal for coworkers, which consisted of a huge submarine sandwich and cookie to be shared. I hope that you will stay following the lecture for discussion and question and answer, and then for the reception in Tom's honor. I can't promise a sub and a cookie, but it will be a wonderful occasion to celebrate and congratulate him. I will say in Gaelic, I think I'm going to try, Cove Arjus, which means congratulations, and Rath D'Ort, Ra D'Ort, which means the grace of God be with you. Please join me in welcoming Thomas Brennan, the Stanley S. Surrey Professor of Law.
Thank you. Thank you so much, Martha, and so many thanks to all of you for being here, those who have traveled so far, my colleagues, and wonderful students. Thank you so much for being here. I thought that this topic, when I picked the title, Focus on Perspective and Taxation, could cover a lot, and it can. There are two particular things we'll talk about. But before getting to the substantive matters, I just wanted to say a little bit about Stanley S. Surrey to follow on what Martha already said. Of course, he died in 1984, and so I never had the chance to know him, but I've heard of him. He's an absolutely legendary figure in tax. And I went back to the volume of the Harvard Law Review that honored him after his death, and I found two quotes. The first was by Erwin Griswold, who said, "By common consent, he was the greatest tax scholar of his generation, but he was more than that. He was an activist who wanted to see his scholarship put to work, and he had the talent, the energy, and the personality to make him an effective public servant in and out of public office." And then a second quote from Bill Andrews, who was my teacher of the basic taxation course: "We will continue to enjoy the fruits of his labor and wisdom and influence for many years to come. It is hard to imagine that there will ever be another in the arena of taxation whose name and career are so nearly synonymous with virtue." So it's truly an honor to receive this chair and to receive this chair in his name. And I also can't help but say it is an incredible honor to follow the first Stanley S. Surrey Professor of Law, Dan Halperin, who's here, because equally wonderful things can be said about him. So, for the substantive topics, there are two topics for today, each one of which fits into focus and perspective. The first is the nature of ownership, and the second is the future of taxes. These sound profound and big, and they're meant to sort of sound impressive. More specifically, how do we define economic ownership? And the students who are in my seminar will know I'm talking about Delta, and Martha knows from her mention of Delta that that's what I'm talking about. And the second, I'm particularly talking about uncertainty in future tax rates and the relevance of that topic. So those who have heard me speak on numbers of issues before will see some similarity to other things that I've said. But hopefully there'll be a few interesting points here, and one way or the other, I hope it will convey why I think this is interesting and fun, even though it's tax and it's math. But actually, tax and math are interesting and fun. So, all right. So these are the two topics for today. Ownership. Ownership is a big concept. It has been around for a long time. Tax consequences depend on the identity of an owner and who exactly owns property. The person that we're going to tax on income from property is the owner of property in general. But it may not be clear who the owner is. So if only one person is associated with the property, then it's crystal clear and you just have one person. But what if ownership is divided in some sort of way? So in the very simple case, one person owns everything. But in the more complex case, there are two people. And perhaps they don't own it pro rata in some sort of simple to understand shares. Perhaps they have contingent claims. Perhaps we could call it debt and equity on the underlying asset. It becomes a lot more complicated to figure out how exactly you should tax the income derived from the property or gain on sale of a property or whatever else. As I say, this has been around for a long time. I read some of Stanley Surrey's older papers, and there's a quote that says, "Suppose the owner, A, shares his rights in property or income by transferring some of them, but not all of them, to B. The approach is to determine whether sufficient rights have been given to B to make him the subject of the tax." That was 1933 by Stanley Surrey. I think he was 22 years old at the time. He evidently graduated from law school at 21. And, so he was thinking about these things a long time ago. We're still thinking about them now. I dare say 80 years from now we'll be thinking about these still. But this is a persistent problem. If anything, in the meantime, from 1933 to today, financial innovation has made the problem even more acute by constructing derivatives that are created in an effort to exploit the difficulties the tax system has with identifying the correct owner. You can sort of make a mockery of the attempt to impose rules and just sort of dance around them. Of course, the government has reacted. More rules have been developed to address the problems. But of course, the addressing of the problems is incomplete and inadequate in various ways. So let me try to make this concrete, because I don't want to assume that everyone has a tax background here. I know many do, so bear with me. You do, but suppose, for concreteness, that you own stock or some sort of asset, and it appreciates. Things are going up, and you're happy over time. Then there's some unrealized gain in it. And in general, under our realization-based system, we're not going to tax you on that gain until you dispose of the stock in some sort of way. So people might say, well, look, I have the stock, and I would like to sell it. I would like to eliminate all the risk by taking another. So if what I'm drawing graphically here is to say, let's have the payoff from holding stock on the horizontal axis, and the stock price on the horizontal axis, and the payoff that you're going to get on the vertical axis. If you just own stock, it's a 45-degree line. If you sell a share of stock, it's subtracting a 45-degree line. If you do the subtraction, and we sort of take obvious conventions for what subtracting two graphs means, then one graph minus the other graph gets you to 0. When you do that sale, you get the stock price, and you neutralize your risk, because you have 0 here at the end, but you pay a tax. So now comes the financial innovation. Say, okay, I have the share of stock. I like the share of stock, but I want to get rid of the risk. I just want to take my appreciated gain. Thank you very much. So why don't I sell something that has a little wiggle in it? It's not quite the stock. We could give this a name of various sorts, variable prepaid forward contract or whatever else, but it's not quite the stock, but almost. Then when you do the subtraction, you'll get money. The amount of money, not exactly the same as the stock price, but it's the price of this contract. If we're assuming the same sort of conventions for subtracting graphs, we'll get something that is not quite 0, but it's almost 0. And so the name of the game here is to make that close enough to 0 that you have very little risk, but far enough from 0 that you don't get taxed. And people do this. People do this to avoid taxation indefinitely, perhaps. If you're somebody who anticipates being able to maintain these positions until they die and get a step up of basis at death, then you're not going to be taxed ever. If you're somebody, like in the case of Philip Anschutz a couple of years ago, who says, oh, gee, I was holding my stock in a C corporation, and I converted to an S corporation. I've got to hold the position for 10 years, otherwise I'm going to get double taxed. Then you do this for 10 years. There are various reasons why people might want to hold a position like this for a number of years. Okay, so now let's focus in. See, focus and perspective, I really will make reference to those. So let's focus on this particular payoff diagram, this variable prepaid forward contract, and ask, what is it? Is it like stock? Is it not like stock? Well, if we take our microscope and focus on the left-hand side, it's like stock. That looks just like the stock if I forget about everything else. If I go to the middle, well, that looks like a risk-free bond. I'm just getting the same payoff one way or the other. There's no variation whatsoever. If I go there, it's like stock. And if I go somewhere in the middle, I'll get one of these weird kinks, and it's sort of like a call option. And what exactly do I do with that? So maybe we'd want to inquire as to what the stock value is going to be, the underlying stock value. So this is a contingent claim based on the stock value. What is the underlying going to do? Is it going to form a distribution that lives over there in the left-hand side, that we think its payoff is going to have a mean like that and a standard deviation around the mean? Or do we think that it's going to be somewhere here in the middle and look like a risk-free bond, somewhere here, or perhaps this, and be the whole thing at once? One might imagine that the rules that Congress has crafted to deal with constructive sales of the sort that I'm talking about, or regulations promulgated thereunder, might make reference to where you think the stock is going to be and how much variation there is in it. One might imagine that, but there are no such laws and are no such rules. They rather simply focus on how the diagram looks and sort of meditate on it for a bit and forget that there's an underline that you might care about the distribution of. But okay. So we have this problem that people are trading in these things, and we'd like to know, are they like stock or are they not? Do they represent ownership of stock sufficiently or do they not? It comes up in a lot of contexts. Constructive sales are when you have this appreciated asset and you're trying to sell this thing that looks sort of like the asset but not quite. That's what I've just been discussing. And Congress addressed this in Section 1259 of the Internal Revenue Code passed in 1997 that sort of says if something looks close enough, then we should treat it as a sale. They asked Treasury to write regulations that will explain when it's close enough. That was 20 years ago, and there are no regulations. So that's where we are right now. Then there's also a constructive ownership issue. Sometimes you don't want to own the underlying. So in constructive sales, you do want to keep owning the underlying. In constructive ownership, you don't want to own the underlying. When might that be? Well, if you're engaged in some sort of active trading strategy that's generating short-term income, and you'd like to wrap it in some sort of option that will be a single unified asset, and you want to treat that as a long-term capital asset that you'll keep for a long amount of time, then you'd say, I don't want to be deemed to own the underlying, I want to own the wrapper. So that's what 1260 is about. No regulations under that either. That was just 2 years later. You could also ask debt versus equity. So the things that I've been talking about don't necessarily have to do with selling something or buying something or owning some underlying. They could just be to do with contingent claims, say, on corporate assets. And we know that debt could get riskier and riskier as a corporation gets more and more levered, that equity gets more and more like the underlying asset as it becomes, the amount of debt goes away. Which one of these is ownership? When does debt become like equity? What do we do with hybrids in the middle, debt that's convertible into equity, the like? So Section 385 was enacted in 1969, and it asked, how do you tell debt from equity? And it gave a couple of factors, and it said the Treasury should really look into this. In the early 1980s, the Treasury promulgated regulations and then withdrew them. I think that they were, I speculate that they were afraid that perhaps by drawing too many bright lines, the regulations might have been gamed, or might have been gameable. There have recently been regulations under 385 for the purpose, or not exclusively for the purpose, but dealing with affiliated groups of companies to try to, among other things, make it less advantageous to invert from being a US company to abroad. But the regulations don't address the broad issue of distinguishing debt from equity for circumstances other than affiliated groups of companies, really. Then the last, so there are many contexts. The last context that I'll mention is dividend equivalence. And so dividend equivalence is a situation where somebody, let's say from a foreign country that doesn't have a tax treaty with the US, wants to buy stock in the US and wants to receive dividends on that stock, but doesn't want to pay the 30% withholding tax associated with the dividends on that stock. Then what a foreigner might do is say, well, I want to invest in a contract that looks a lot like the stock but is not the actual stock. And they get payoffs that are a lot like the dividends but are not the actual dividends, and thereby escape the 30% withholding tax. 871M was enacted in just 2010. It's the most recent of all of these rules. And it's designed to say, if you invest in a contract that looks a lot like stock, then you're going to be subject to taxation on the things that look a lot like dividends that come out of it. And the reason why I bring this up, even though it's the most arcane, perhaps, of all the ones that I've mentioned, is because the Treasury has actually written regulations here. And what the Treasury has done is to say, let's use delta. And what is delta? Well, it says, give me that crazy contract that you cooked up and figure out how the value of that contract changes per change in the underlying asset. So if my stock price goes up by $1, does my contract price go up by $1? Or does it go up by 50 cents? Or does it go up by 25 cents? That's the thing that you're measuring. And hopefully by measuring that sensitivity, you're going to tell how much like the stock it is. To write it a little bit differently, you might say, if you were doing a regression perhaps, that the contract price looks like delta times the stock price plus some sort of residual, where the residual is noise that's not correlated with the stock price. And so this is trying to tell how much stock there is in the position. Okay, so that's a big idea. This is actually in regulations. All of this you might be saying, well, Tom sort of likes math, and it's a little unusual, all the things that he's saying, but this is in the regulations. You could also say, take it from an elasticity point of view for the economists in the room and talk about percentage change of the value of the contract over percentage change in value of the underlying asset. That's a completely fine way to do it, too. That's the same as delta, except rescaled by the stock price over the contract price. You have to be a little bit careful when the contract price is 0, but otherwise it's essentially the same thing. So this looks great. It's a good way to measure how much there is. Are there problems? Well, yes, there are problems. So first of all, identifying a well-defined underlying asset is hard. So when I own a call option on IBM stock, is the underlying asset IBM stock? Or is the underlying asset rather the assets of IBM? And if those assets in turn are other things that have assets below them, we have a bit of the turtle is all the way down problem. The turtle is on the back of the turtle, but There's also the issue, relatedly, of spurious correlation. If I own IBM stock, or I own a contingent claim on IBM stock, and I try to figure out its delta with respect to, say, Microsoft stock, perhaps there'll be some correlation. Perhaps it'll be, 0.7 or 0.8. And if there's some sort of threshold in the regulations that says, if you're above 0.7 or 0.8, then you own the underlying. So now maybe you are deemed to own IBM stock and Microsoft stock and some other stock. So there's an issue about what's the right underlying and how do we identify it. There's also the problem of embedding in a larger instrument. So what if the thing we're interested in is this little red box? But I know you're interested in that little red box, so I'm going to hide it in a big blue box. And how do I do that? Well, I attach a lot of debt to the thing. So I don't have just the straight call option. I have a convertible bond, and its call option added together with a bond. And now you're going to have a lot more trouble identifying exactly what's there. Okay, we can try to find ways to isolate the components of interest. Another is splintering. So if what you're interested in is the red box, I'll rip the red box into pieces. And the red box altogether will have a delta of 1. But each piece has a delta of 0.25. You put all 4 of them together, I get a delta of 1. But, so we'll have to worry about aggregating. OK, maybe we can deal with these issues. There's another question of model dependence. So I want to be able to put the Black-Scholes differential equation on the board. But so there it is. How exactly do we calculate this? What is the procedure that we will use in order to figure out what delta is? How do we value this thing? We've got to make assumptions about how the stock price behaves. Do we, along with Black and Scholes, say that it's going to be log normally distributed asset prices and that this is the appropriate equation to use? Or is it something else? The regulations deal with this question, or punt on this question, as you like. They say use a commercially reasonable method. OK, I mean, it's better than nothing. but that's how they answer the question. There's also the problem of isolating a portion of the dividend stream. So for many of these assets, they are essentially, in terms of economics, just the right to the future cash flows that will come from the assets. And there'll be some initial set of cash flows, and then there'll be some complementary set of cash flows beyond the initial run. So if you think that the initial run and the complementary run have the same nature of risk, then you might be able to make construct a financial instrument that makes reference only to the later dividend payments, skips over the earlier dividend payments, but has the same sort of risk that you want it to have. But because it's missing this initial amount, the delta calculation doesn't work right. Turns out you can fix this with the elasticities. But the final problem is the dynamic nature of delta. And this is perhaps the biggest problem, that delta changes over time. So just because it looked like it was all stock in the beginning or half stock in the beginning does not mean it will necessarily look like that in the end. And along the way, it may go much higher, much lower, everything in between. I want to try to convince you that this is a real problem. And this is one of the things that I think is actually a fun example. So for those of you who have read it already, I apologize. But this is the coin flip example. So here's the instrument. What you want to do at the end of the day is essentially, let's say, to own a long position in IBM stock. But you don't want to buy the IBM stock because if you do, then the dividends that are paid on it, let's say, are going to be taxed to you at the 30% withholding rate. So what you will do is you will buy an instrument that specifies that a fair coin will be flipped the day after you buy the instrument. So you flip the fair coin the day afterwards. If the coin comes up heads, then you get the IBM stock. Or your instrument will make payments to you that are exactly those on the IBM stock. If the coin flip comes up tails, then you will get a short position in the IBM stock, meaning you will owe everything that you would owe if you sold to somebody else the IBM stock. What is the delta of this instrument on the day you buy it? Well, it better be 0, because it's just as much plus as it is minus. What is the delta immediately after the coin flip? Well, it better be either +1 or -1. OK, so now what do? Well, you say, let's repeat. We do it once. There's a 50% chance we get what we want. If you don't like it, close it out. Sell the instrument, buy a new one. Do it again. There's a 50% chance you'll get what you want. You don't like it, you do it again. After 10 times, there's a 99.9% chance you'll have what you want. So this seems pretty bad for, for the delta test, at least if you don't check back in a later time. And the 871M regulations do not check back in. And the thing that I've heard as the IRS response to this is, well, we have an anti-abuse rule, and that will fix this. Great, so I'll obfuscate this. And then I will make it totally unclear that the thing that I'm doing is accomplishing essentially this. I mean, to rely on an anti-abuse rule to catch something like this is challenging, at the very least. I think the better thing would be to check in regularly and see what the delta of the instrument is, but I'm told that's very administratively hard, that you have to go and follow up and figure out who owns it and what exactly the situation is. So should we use delta, given all of this? It's a wonderful idea. It will tell you what the instrument is doing, but it's gameable if you don't do it just right. Well, I would say it's a tool, but it's not a panacea. Here are my graphic ways of representing that. Hammer, but not a pill. But it's a versatile and useful tool. It's like a Swiss Army knife. It does a lot of things at once, and it does them kind of well. So what I'd say is we should use it appropriately. I view it a little bit like a very high-tech, modern version of present value analysis. I mean, it's a tool from economics that lets you think about what is this thing that we're doing and how can we evaluate it. It's subject to assumptions. It can be used inappropriately, and it can be used carelessly. So be careful not to do that. But I wouldn't say disregard it entirely. I'd say use it as a piece of information informed by, sort of careful crafting of rules and regulations that will use it. What can Delta teach us? I would say it can teach us two things. It can teach us how to make our walls as firm as possible if we want to. So if there are barriers between what's a dividend, what's capital gains, what's whatever else, then it might teach us how to make the walls as firm as we possibly can. Alternatively, it might tell us how little sense some of our walls make. So if that's a person near the wall and the wall springs a leak, the person might plug it. The wall springs another leak, you plug it, springs another leak. So, but I mean this sort of seriously. One of the ways that I'm using Delta right now, along with Bob McDonald, is to try to formulate precisely what the tax advantage is to a hybrid debt instrument. So how do you price the tax advantage there? Well, you're going to do something that's essentially breaking the hybrid instrument into its underlying pure debt and pure equity pieces. And say, how would the pure debt and pure equity pieces be taxed if they were not combined together into a single instrument? And then how are we taxing the single instrument? And it's only by using this sort of methodology that you're ever going to be able to put an exact price on something like this. And so it can teach you a bit how difficult or how large the magnitude of the problem is. And it can also teach you just how difficult it is to prevent gaming, like the coin flip example showed. This makes sense? So there is one other topic, if that's you have the patience for. Okay. So the one other topic is future tax uncertainty. So what do I mean by future tax uncertainty? Well, here we have taxpayers who have a choice between paying a tax now or paying a tax later. And what are examples of this? Traditional versus Roth retirement accounts. Traditional retirement accounts, you don't pay a tax now, but you pay it later. Roth retirement accounts, you pay a tax now, but you don't pay it later. Or repatriation versus deferral of overseas corporate earnings. So you can either pay the tax now, repatriate the money back to the US, or you can wait and repatriate it back someday later. In both of these cases, you're faced with a choice of, should I pay a tax now or should I pay it later? Oftentimes, when we talk about these questions, we talk about time value of money and deferral and many other interesting things, which are all important. But today, I want to focus just on the tax rate uncertainty dimension, the fact that we're not sure what the future tax rate is going to be. And just to illustrate things, so suppose you have an initial pre-tax amount, you pay some sort of tax on that gross amount, let's say 33%. Then your investment grows to some future point. You could alternatively say, Well, let's start with that same initial amount, let it grow pre-tax, pay the tax applicable at the end, and then if the two tax rates are the same, you'll find out they got to the exact same place. Nothing happened. So if all else is equal. So should you decide to pay at the beginning or should you decide to pay at the end? Well, if T1 and T2, the beginning and ending tax rate, are the same because multiplication commutes, you don't care. But if T1 is not equal to T2, then you're going to want to pick the lower of the two of them. You don't know in advance which one the lower of the two is. So just to make sure that it's clear why this is an important question, the amounts of money at stake are really enormous. The unrepatriated earnings are currently estimated to be at least $2.6 trillion, at least in 2016. That was the Joint Committee on Taxation estimate. The retirement account amounts in traditional and Roth IRAs are 6.2 trillion and 0.7 trillion respectively. So large amounts of money at stake. And the concerns are because we know the tax rates can change in the future. We know holidays have been given for overseas earnings repatriation. We know that there have been incentives given to put money in Roth accounts. You have to ask whether the theory and rationale for the original policy was conditional or viewed as an important assumption, the fact that tax rates would remain the same over time. Perhaps it did, perhaps not. Perhaps even if it did, that's no longer a relevant concern to us, but it's something worth thinking about. Another problem is budgetary mischief. That essentially the Congress looks at a 10-year window for how much it's going to cost them to do certain things and how much revenue they're going to collect. So if somehow they can get money into the 10-year window at the cost of money outside the 10-year window, well, then that looks like a revenue raiser to them. So these are real concerns. Other concerns are capital allocation distortion. Do we mind that $2.6 trillion is overseas? Maybe it's appropriately overseas, maybe not, but there's a concern that part of the reason why it's there, at least some of it is there, is tax motivated. There's also accounting mischief as contrasted with budgetary mischief. So corporate firms don't have to report permanently reinvested earnings as deferred tax liabilities. I mean, this is more of a problem for the accountants than the lawyers, but it's yet another concern. And there's a large allocation of future tax risk to people like retirees. So if you're invested in a traditional IRA or 401k, you're going to be subject to whatever future tax rate is applicable. For that matter, the Roth holders may be subject to future taxes too, especially if a consumption tax is imposed and there's no relief given. So one way I can think about this is we're causing people to build up to sort of cliffs. We're sort of building a big mountain, lots of money getting put overseas, waiting for the big holiday, lobbying for the big holiday, lots of money getting put in retirement accounts, sort of thinking that there's going to be some particular tax rate. And so it would be better if we didn't make people concentrate risk in big piles like we do. So what do I have to say as things that we might do about it? I have three, but they'll be three quick things to suggest to you. The first is that we could have securities that are tied to future tax rates. So have bonds that have a payoff that depends upon the future tax rate. This, I think, could be a neat idea. It would provide an interesting counterweight to the push for rate reductions. So this is a schematic of a counterweight, sort of counterbalancing how much push there is to reduce tax rates and give another holiday. It could also be used as a hedging tool, and it would yield information about market expectations through its pricing. The downsides are it'd be very difficult to create the market and define the instruments. So I don't want to oversell this, but just as a conceptual matter, it's an idea. Another possibility is to smooth tax rates. So there's no reason why we have to have everything depend upon just the tax rate applicable at the future moment. That's how we've been treating all this discussion, but there's no reason why. We could instead say, let's have a blended tax rate over the years during which you're invested. And so when you take money out of a retirement account, you say, well, what was your average rate over your life? And that's the thing that we're going to apply to you. Or if you're a corporation that's bringing money back from overseas, well, what was the average rate applicable over the time that you were invested overseas? So instead of a cliff, I think of this more as a sliding board. Sort of go really gently and smoothly. Could get you closer to a type of income tax averaging, which wouldn't be necessarily a bad thing. Downsides are it could be very difficult to do the calculations necessary, but perhaps less so now that technology has improved and computers could do some of this. Finally, budgetary changes. So we could include a portion of the future tax to be collected in the current window. We could say, look, Congress, you're going to collect, if you've got $6 trillion in traditional IRAs that's not going to pay you any tax until outside the current budget window, or at least some large chunk of it isn't, that's not really fair to just wait until then. You should bring some of it into the current window. And so that would be a revenue raiser for them. They would like that. But what you would have to do with that then is say, well, we're going to create sort of a deferred tax asset for the government. And should you impair it, then you will have a cost in the current budget window. And so this will give you a strong reason not to impair it. So it works sort of like a commitment device. That would be good. That Congress would feel that it was a little bit constrained in a way that might be meaningful. And it would avoid myopic revenue games. And Congress might well do it because it could be a current revenue raiser, even a very large current revenue raiser. The downside is, of course, nothing's to stop Congress from changing its budgeting rules yet again, 10 years from now or two days from now. There's no reason why not. So it's hard to necessarily fix that entirely. But so the review and conclusion, as we're getting on in time, is Delta can help understand ownership and maintain walls. And it can also help understand problems with walls. Tax uncertainty and deferral options give rise to cliffs. Smooth taxation would help to alleviate pressure of the concentrated risk that we're seeing. But after all, aren't open fields and slides preferable to walls and cliffs? And so that's about all that I wanted to say.
So we've had walls, we've had cliffs, but there's one more thing, which is chairs. And so I would very much like to give you the chair.
Oh.
And would you please sit in the chair?
Oh, thank you. Thank you very much.